For the last few weeks, I've been teasing the ideas that I found an amazing robotics company at a $1 billion market cap, growing 30 to 50% in revenues, trading under 10 times sales with over 20x on the upside. And I told you guys I'm eventually going to share the stocks on YouTube, and I'm going to do that today. I'm going to give you the entire thesis on the stock and everything around it. And this is something that I pretty much don't do very often. I mean, the last time I revealed a growth stock that I just bought on YouTube was Hims and Hers, and it was around $11. And I have a history of talking about stocks that I buy and then they go down after and everyone gives up on them, and then they go up much, much higher later on. So I'm going to talk about this one. It has very much similar to NVIDIA. It has a lot of characteristics similar to NVIDIA, very similar setup, and it's something very promising. No one is talking about this one on YouTube. Everyone is talking about robotics and physical AI and Symbiotic stock and Serve Robotics and Zeta and other platforms, but this is a special one. And I think you're gonna enjoy it. But if you do enjoy it, all I'm asking is please press the like button and let me know what you think in the comments. Okay. Now, normally, whenever you have a trend, you have maybe the AI trend, or you have any trend in general, or maybe even the gold rush. Back in the gold rush, the people that made the money were not the miners that were mining the gold. It was the companies that were selling them the shovels. And this is a very well-known quote in investing. And this is why NVIDIA has done so well. Because when everyone digs for gold, sell shovels. NVIDIA is selling the shovels to Microsoft and Google and Meta. They're doing all the AI, they're doing all the work. NVIDIA is selling them the shovels. And I believe the next trend is mainly automation. We have a shortage of workers in the United States, especially after all the immigration that's been happening. Most of those factories have to be automated. Within robotics, we have other industrial automation needs, and automation in general, and taking software AI, applying it to physical AI, this is automation. So automation is the next big trend. And I was looking not for the company that's making robots like Symbiotic, but for the company that's selling shovels in the gold rush. And this is what the company that I'm going to talk about today does. Now, I'm going to do something very special, and I'm not going to show you the price. This is something that Warren Buffett tends to do. Whenever he looks at an investment, he doesn't look at the price. He looks at the thesis. He evaluates the company. If he finds that it's a good opportunity, then he looks at the price. And this is what I did to my group members when I bought the stock, and I'm still buying the stock, and I'm still averaging up on the company. Because when you see the price, you see the stock being up, you're going to believe you're too late. And I thought I was late a few weeks ago, and so far I'm not late. And the stock still has over 20x on the upside. But the stock is a company called Ouster. Ouster sells LiDAR sensors in robotics, into industrial, smart infrastructure, and automotive. Now, anything, any kind of robots, any industrial applications, they have maybe partnerships with companies like John Deere, with companies like Komatsu, which has a lot of those mining equipments. Any kind of industrial needs or any kind of needs in factories, robotics, infrastructure, all of those things, they need sensors, or else those are the eyes of AI. For AI, for the robot to be able to do those applications, they need sensors. So I'm betting on the company that's selling the sensors. I don't have to bet on who makes the best robot or who makes the best machines. All those machines, they need LiDAR sensors. And this company is very different from what you believe in terms of automotive LiDAR. This is completely different. They have a moat, they have a competitive advantage, and they have 52% gross margin. And I'm going to show you all the numbers very shortly. But the first example in robotics is Serve Robotics. So many people are buying Serve Robotics. They have those robotic robots you've seen maybe in many different places in San Francisco and in other cities. Well, if you look at this robot, they have the LiDAR sensor, which is from Ouster. So instead of betting on Serve Robotics, you're buying Ouster, which makes those LiDAR sensors that all those robotic companies need. So this is a beautiful, beautiful business model. They believe this is a $14 billion TAM. I think it's too low. I think it will end up being much, much higher. The second area for Ouster is mainly in industrial. So a lot of the industrial machines, warehouse automation, agriculture is a big one, mining, construction. Again, John Deere is using them guys within a lot of their equipments to try to automate a lot of the farming and agricultural equipment. This is an $18 billion TAM, huge for a company like Outstore. Then they have automotive. But this is the biggest misconception with the company, is it's not really a automotive LiDAR company. There's a lot of LiDAR sensor stocks, but if you compare their margins to Outstore, it's not even close. If you compare their growth to Outstore, it's not even close. The biggest advantage that Outstore has is that Outstore is not really too much into automotive LiDAR. Automotive LiDAR is very competitive. All those companies are into automotive LiDAR. For example, there's a company called Innoviz. Innoviz has a partnership with Volkswagen to give them all those LiDAR sensors for the Volkswagen robotaxis. Now, they had also a partnership with a company called Waymo a few years ago. But once Waymo scaled, now Waymo has their own in-house LiDAR. So all those LiDAR companies in the automotive sector, they go and they fail, and they go into markets and they fail, and there's so much competition there. Then they want to diversify their business. So they try to enter into industrial. They try to enter into robotics, where Outstore has a massive competitive advantage, and they fail. And then they go back to automotive LiDAR. So the biggest advantage that this company has, and reason why it has 52% gross margins, is that it's not in automotive LiDAR. In fact, right now they are getting into automotive LiDAR for growth, but automotive LiDAR is the worst kind of LiDAR sensor-oriented company you could own. And there's many of them, but this is extremely competitive scale. And once the automakers, they scale, they develop their own in-house technology like Waymo did. So do not invest in automotive LiDAR companies. Now, what makes this company again special, you look at the last quarter, 30% revenue growth. They grew sequentially 12% quarter on quarter. Massive revenue growth. Non-GAAP gross margin was 52%. 52% gross margin, guys. This is not what you would expect in a highly competitive space. In a competitive space, you would expect 5% gross margin, 10%, because they have no moat. But they do have a moat because they specialize into industrial and to a lot of the agricultural and other LiDAR equipments outside of automotive. Automotive is where there's so much competition, very low gross margins. Outstore has 52% gross margins, and they've been increasing over time. Sensors up 33%, 5,500 sensors, pretty amazing. Now, what sets this company apart is they have a special kind of business that no one is really in, and this is a massive TAM, and it's mainly into smart cities. So if you go on a lot of the traffic lights, a lot of the traffic monitoring system in the United States and across the world is very, very old. And Outstore is using AI, and they're using their capabilities of those LiDAR sensors for smart infrastructure. So they call it Outstore Blue City. Outstore Blue City is an amazing platform, and this is a video, you can watch it. This is how deep you can go into the analytics, and a lot of police, local officials, they love the Outstore Blue Cities. They have deployed it in many places in the United States. It was a huge success. And actually today, they announced that they're going to expand it over 100 intersections in Utah. This is a massive expansion for Outstore. Now, the best part about this business for Outstore is that it's not just the hardware that they're putting on the traffic monitoring system, but they also have a software revenues. So for them to access the LiDAR technology, they have to purchase recurring revenue subscriptions from Outstore to access to technology. So in this way, Outstore is not just a company that's selling hardware, but it's becoming into a software company over time. And imagine how resilient it is to have a traffic monitoring system, recurring revenue on software. This is like amazing gross margins, just insane stuff, and it's an amazing from the company. And this is from the latest earnings call. And they said, starting with a software attached business, in 2026, the world's most watched sporting event is coming to the United States, the FIFA World Cup. We won an award to deploy Outstore Rev7 and Blue City across dozens of cities at a World Cup host city to bring real-time, on-demand traffic data to reduce congestion and improve safety for the visiting fan. We also recently expanded an agreement to meet the demand of Utah, which I just told you about, we signed 3 exclusive partnerships to bring Blue City to major markets in Texas, Michigan, New York, and Pennsylvania. So this is a massive business for Ouster, and it's on the bringing not just hardware revenue, but recurring software revenue, which is very high margin over time, and that sets the company apart. What also sets the company apart is that the company is the only company that is approved for Department of Defense contracts. All the software LiDAR companies, they're not approved because of Made in USA standards. Ouster is the only one that is approved to make for them to use those capabilities into autonomous drones and other drone capabilities. And this is why companies like Anduril uses the Ouster LiDAR in their own drones. And this is what they said: we continue to solidify our competitive moat. In the first quarter, Ouster OS1 became the first and only 3D LiDAR sensor to be approved by Blue and certified by the Department of Defense. And they won a pilot program for certain security in the U.S. Army bases. So the company is not just a company that's like just selling hardware, but they have a moat around it because they have an advantage industrial. They have an advantage into this area, not outside mainly of automotive. They have a software business with Ouster Blue City, which is very resilient. And then they have the moat because they are the only company that they could be used for Department of Defense contracts. And this is coming up the last 2 months. That's why the stock is up so much, because this is a new area of growth for them. And this is what they said on the latest call. They said, we need to think beyond the US when it comes to the defense market, and it includes US and Western allies, as Ouster is the only 3D LiDAR certified to be used in those applications. And that's why the stock got an upgrade to $50 per share. The company's killing it. No one's talking about this stock. $1.7 billion enterprise value. And it's just an amazing company. Now, Ouster does have a few risks. One of them is the company is unprofitable. It's been losing less and less money over time. You could see the massive improvements in earnings per share. But the company, as $1 billion market cap or enterprise value, should not be focused on being profitable, should not be doing buybacks. They should not be doing dividends. They should be focusing on growth, focusing on their moat, focusing on innovation. And that's why they spend a lot in research and development. If they did not spend so much in research and development, the company would be profitable right now. So it's getting closer and closer to profitability, and the company is unprofitable. It's expected to be profitable by 2027, which is not normally a bet that I make. Normally, I only buy stocks within 1 year of profitability, but this one, I think it's going to be profitable by Q1 of 2027. So it's more speculative, of course. The second risk is because it's not profitable, the company is diluting stock like crazy, around 2 million shares every quarter from 47, 49, 52, 54. And it's really bad. But that's how it is with those growth stocks, unprofitable growth stocks. They have a lot of potential. It's more speculative, and they're not going to be doing buybacks right now. So for them, they're diluting stock. And that's the way it is until it becomes profitable in 2027. We should be diluted less. But I think the dilution is worth it for the growth and for the potential of the company. Now, looking at the company itself, this is their guidance: 30 to 50% annual revenue growth. For the next 5 to 10 years, they expect to grow 30 to 50% per year in revenues. I mean, no company gives such guidance, but the company is so confident in their ability to grow 30 to 50%. The TAM is so large in terms of automation. This is a trend that's just beginning, guys. Imagine factories, a lot of things within mining, a lot of things within machinery, and Ouster smart cities, all smart cities, also cities in the United States and all across Europe and the world. They have a TAM, and Ouster can reach them and make money from them. And then you have the defense side, and it's just amazing. So 30 to 50% annual revenue growth, maintain 35 to 40% gross margins, and keep operating expenses at or below Q3 2023 level for them to drive operating leverage and for them to become profitable by Q1 of 2027. Now, for my upside potential, this is my upside. Ouster is expected to make $145 million in revenues for 2025, 145 million. I put it in my calculator for the next 10 years because this is a long-term trend, a long-term investment for me. And I put in 35% revenue growth. Now, realistically, they can grow more than that. Some LiDAR companies right now are growing 50 to 60% in revenues. And now Ouster is growing 30% in revenues without the defense market. The defense market has just opened for them. They still have not made any money from the defense market. So with defense, they should grow 40, 50% for the next 10 years. I know it sounds crazy, but at 145 million of revenue, it's not hard to grow 30, 50% per year. So I don't believe this is too optimistic. But I'm using 35% for the next 10 years. I get $2.9 billion in revenues. If you want to make the calculation simpler, we can use $3 billion. So $3 billion in revenue 10 years from now by 2035. Now the company is trading at an enterprise value of $1.7 billion. So we're going to use 1.7 billion as they have 220 million of cash and no debt. They have zero debt. So this is good from the company. And maybe they're going to do an acquisition soon. But 1.7 billion. Now the current multiple on Ouster is 10 times sales. When I first bought it, it was at 6 times sales. So it did get an expansion. But after I showed you everything, guys, this is a company that's in the center of industrial automation. This is a trend that's just beginning. 30 to 50% annual revenue growth, 52% gross margin. They have recurring revenues from Ouster Blue City software. This is one of the most resilient sources you can take. 10 times sales for such growth is really not expensive at all. It's not expensive at all. I would not be surprised if it would be trading 20, 25 times sales. I mean, Duolingo is trading at 22 times sales, and you can't even compare Duolingo to the potential of Ouster. So I think 10 times sales isn't too much. But I'm going to use two case scenarios. We're going to take the $3 billion, okay, by revenues by 2035. We're going to time it by 10 times sales. This is a $30 billion enterprise value. The current enterprise value is $1.7 billion, which would be a 16.5x on the upside over the next 10 years. Now, if you want to take some dilution out of it, maybe it's 12 or 13x. So 13x on the upside over the next 10 years with a company like Ouster using 35% revenue growth. Now, let's say they get a multiple contraction and they trade at 5 times sales. Well, we could use the $3 billion and we time it by 5 times sales. This is 15 billion enterprise value. The current enterprise value is 1.7. This is around a 7, almost an 8x over the next 10 years. So we get an 8x with 5 times sales, with 10 times sales, which I would not be surprised if it sustains, or if it gets beyond 10 times sales, as investors are waking up to Ouster. No one talks about it. We get around a 16x over the next 10 years, and this is using 35% revenue growth, not 40%, which would not be shocking with a company like Ouster. It could be 20 to 25x on the upside from here with an amazing company like Ouster. Now I'm going to show you the chart. This is the chart of Ouster, and I left it to the end for a reason. Because when I first bought the stock, and I showed it to some of my group members, I bought the stock, my first buy on Ouster was around $21. So I started buying at 21. The reason why I left the stock price at the end is because the stock is up from like $7 to $21. Buying it at 21 is the same thing as buying it right now at 34. I know it sounds crazy. And I know many of you will tell me you should have shared it earlier. But if I shared it at $21, you would have told me, oh, but it's already up from $7. This is because most investors, they cannot get over anchoring bias. They cannot get over watching price action. For me, I don't care if the stock goes up 500% today, if it goes up 500%. But if I think it could still 20x, I'm going to buy the stock. I'm going to use small position sizing because it's up, and then I'm going to add more over time. So I started buying at 21. I buy it a little bit more later on, and then my last buy was like at $30 or $31, which is not far from the current price. And I'm likely going to keep averaging up. This is what I do on those stocks. I averaged up on HIMSS. I averaged up on many of the growth stocks that I bought early on in their days. And this is the best way of doing it, is to ignore price action. Look at the upside. I just showed you 16x on the upside. 5 times sales, we get an 8x with the company. So is it really worth trying to time that 5 or 10% move? For me, it's not worth timing it. And this is what I told group members, which I believe it would be helpful to a lot of you guys. And someone told me, is it too late to buy Ouster? It's the same thing I got asked at 21. Is it too late? I try to show you guys the thesis and the fundamentals so you don't get influenced by the chart. And it's hard to do, but it took me like 10 years to stop looking at the chart. But I said, honestly, yes, but you have to be okay with a potential 20 to 40% pullback in a matter of a month or two. And that comes at any price. When we bought it at 21, the risk was also that it could go back to $10. But the only way you will be able to get over this mental barrier is by understanding the thesis and the long-term potential, which is more than 20x on the upside. So the way I look at it is Ouster has 20x on the upside. It was a SPAC. This is why the chart looks like this and it's all over. But it has 20x on the upside. So I risk a small percentage of my portfolio. I started with 2%. Now it's 4% of my portfolio. So let's say Ouster goes down 50% and I'm wrong. I lose 2% of my portfolio. This is worst case. Best case scenario, I make 20x, which is life-changing returns with one of the best robotic stocks in the market that no one is talking about. So this is how I'm doing it with Ouster. I think it's the best one to buy in this market. And if you want more such ideas, exactly what I'm buying them, ideas you never hear of on YouTube, there's too small to talk about, too boring to talk about. Most of the YouTube stuff is about NVIDIA and things that get views. But the good stuff, you don't hear about them until they're like Ouster, you're not gonna hear about it from mainstream channels until it's trading at maybe 5 or 6 billion, and then you see it on CNBC and all over. That's just the way it works. So if you want access to such things early on, and I have many of them, you can check out my group. This is the link if you're interested. But thank you very much for watching. Not financial advice. Hope you appreciate it. Hope you got some ideas. If you enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.